Understanding the New Financial Paradigm with Sheila Bair is a Minnesota Partnership co-production of the Hendrickson Institute for Ethical Leadership and the Undertold Stories Project of St. Mary's University of Minnesota, and Twin Cities Public Television, with support from Land O'Lakes and U.S. Bank.
Good morning, and welcome to our 7th Hendrickson Forum. At St. Mary's University of Minnesota, we are committed to celebrating and promoting ethical leadership. In fact, our mission statement commands us to awaken, nurture, and empower learners to ethical lives of service and leadership. This mission challenges us to think not only about the students who enroll in our programs, but also about the communities in which we operate. It challenges us to think strategically about how we engage our business community, our local and national elected officials, and our thought leaders in order to foster the next generation of ethical leaders.
The housing bubble burst, leading to a foreclosure crisis in America. The subprime mortgage industry collapses. Lehman Brothers files for bankruptcy. Banks across our state and nation begin to fail. The U.S. economy enters the longest economic downturn since the Great Depression, and in fact teeters on the brink of another depression. This economic crisis forced our corporate and political leaders to face one of the greatest ethical and leadership challenges in a generation. How do we save our nation from going over the fiscal cliff while balancing the demands to protect our economic infrastructure and our citizens, homeowners, and small businesses? Not an easy challenge. Few played a more significant role in answering that question than the Honorable Sheila Bair, who served as the chair of the Federal Deposit Insurance Corporation from 2006 through 2011. During her time at the FDIC, Ms. Bair went toe-to-toe with the most powerful people in government finance and international banking in her attempt to keep the economy from collapsing. She was a tireless advocate for homeowners, small businesses, and yes, the bankers, but the bankers who put the stability of their institutions above their personal and corporate self-interest. St. Mary's University of Minnesota and the Hendrickson Institute for Ethical Leadership are honored to welcome the Honorable Sheila Bair to the 2014 Hendrickson Forum.
Thank you, Scott. That was an extremely nice introduction. I appreciate it. We did, some people say we had a good crisis at the FDIC. I don't think anybody had a good crisis. But we did receive a lot of rewards, and one of the ones that was frequently mentioned was the Forbes magazine nominating me or naming me as the second most powerful woman in 2008 and 2009. And I was speaking to my daughter's elementary school when I was chairman of the FDIC, and I try to reach out, even those busy times, I always tried to reach out to young people and make sure they know about responsible money management, the importance of savings and things. So anyway, when things calmed down a bit, I went over to talk to my daughter's school, and the principal in introducing me said, oh, well, she means 2008, 2009, was the second most powerful woman in the world. So I gave my remarks, and then when I was finished, we opened it up for questions. The little hand went up in the back of the room, and she said, well, who's number one? And so it's very tough to impress kids these days. I did drop to number 14 in 2010. I was behind Lady Gaga. It was quite devastating. And then in 2011, I dropped off the list completely, but I was at the top of the list of the people who dropped off as I was leaving the FDIC. So there you go. I talk a lot I'm always pleased to engage in groups like this, an academic institution especially, talk about ethical issues, because too often it seems like we're almost embarrassed to say, well, is it right, is it wrong? It's just, especially in Washington, maybe not out here in God's earth in the Midwest, where I'm from originally in Kansas, but in Washington and in the East Coast sometimes it's almost like we're embarrassed to talk about ethics. And During the crisis, I was very concerned about people losing their homes. I cared about them, I'll own up to it. And it made me mad that they were losing their homes. There were some borrowers who gamed the system, very unsympathetic borrowers in this process, but there were some people who just got duped with these mortgages. But I knew that if I made arguments impassioned by the morality of this situation, I just felt like it wouldn't really carry the day. And so I would always couch my arguments in terms of the macroeconomics of the policy arguments of home preservation. So I wouldn't talk about keeping people in their homes. I'd talk about keeping houses off the market, because if we had all these mass foreclosures, which was true, going on the market, we would create downward pressure on home prices, and that would hurt everybody. And that was true. But looking back, I think the fact that I felt hindered in my ability to just speak directly to the passion that I had, compassion I had for people, and there were plenty of innocent people who got caught in this terrible maelstrom, was unfortunate. And so I'm glad I'm going to be able to talk about it today, because I do think there was a human dimension to this, an ethical dimension to this, the financial crisis that we don't talk about enough. We still talk about it in macroeconomic terms and the hit on GDP and the contraction of credit and all that in very cold analytical terms, and not enough about the human element. When I first came to the FDIC in 2006, to the FDIC staff's credit, they were already very much on top of the problems with subprime mortgages. And we actually had to go out and buy a database to see what was going on, because I think it's important to understand when these toxic mortgages were being originated, most of this was not being done by regulated insured banks. These were being done by non-bank mortgage originators, being packaged and sold into Wall Street securitizations. There were some thrifts, insured thrifts that did it. There were some insured banks that did it. But the majority of it was being done outside of the regulated insured banking system, where, of course, we had reporting information. And so we had to go out and buy a database. We had to actually go buy some data to find out what was going on with these mortgages. And when our economists went through the data, they just couldn't believe it. The very high starter rates, they were called 228s and 327s, so that the introductory period, so-called, they called them hybrid fixed mortgages, which was misleading in of itself. The first 2 or 3 years of the mortgage was fixed, but at a very high rate, about 9% back then, and then it would jump to 11, 12, 13% after 2 or 3 years. And most of these, contrary to common perception, most of these were refinancings. These were not purchase loans. We did increase home ownership a tad, which has been lost now, and that probably was not a good idea in retrospect. But most of these bad subprime mortgages were refinancings. People who already had 30-year fixed-rate FHA mortgages, already had some equity built in their house. These mortgage brokers would actually go out and troll for people with dinged-up credit history and equity in their homes to put them into these mortgages. So we couldn't believe what we saw, and we had a piece of it. We wanted to make sure, at least, that banks that we insured didn't engage this kind of lending. So we started an effort working with the other regulators to have some stronger standards for subprime loans. And this met with a lot of criticism by, again, primarily the non-banking sector came in, I'll never forget, to see me in January of 2007 when we were having this project underway, and they were just saying, there's nothing wrong with our mortgages. That's not the problem. People just don't want to pay their mortgages anymore. It's even back then, late 2006, this thing was starting to get bad, and delinquency and default rates were going up dramatically. They insisted it was nothing to do with them, nothing to do with their mortgages. It was just people didn't want to pay their mortgage anymore. And so I didn't buy that. We could see these resets. We could see the resetting mortgages were the ones that were going bad. And so we persevered working with the other regulators, and finally, in the summer of 2007, finally in June, we got the tighter standards, but of course by then most of the damage was done. So in tandem with that, in the spring of 2007, we started again working with the other regulators, an initiative to try to get these loans restructured, to get rid of these resets. And thought we got some commitments from the securitization industry to modify these loans as they were being resetting because, in the past people could just keep refinancing because home prices were going up, right? Payment becoming unaffordable, just go refinance again. They couldn't do that anymore because home prices were going down. So they assured us, okay, we're just going to get rid of these resets and extend the starter introductory rate. And we thought that was going to happen. Again, there were public commitments made, not to me, Chris Dodd, others who were pushing for this. And in the fall of 2000, Mark Zandi did a survey of how many of these subprime loans, and the problem was really escalating at that point, were actually being restructured. And it was less than 1%. Almost all these loans were going straight into foreclosure. And so I had an invitation to speak from the securitization industry in New York. And so I accepted the invitation, and I went to them, and I just put it to them a little bit and said, you know, we had all these meetings. You agreed to restructure these loans. You're not restructuring. What's going on? We've got this tidal wave of foreclosures coming in, and you're pretty much not doing anything. And when I was finished, again, opened it up for Q&A, and people were, you know, rolling their eyes, and my remarks are not being received very well. And so a hand goes up, and the guy says, "Oh, well, you don't understand," he said. "We can't help these people. We can't help these people. We give these people a break on their mortgage. They're just going to go out and buy a flat screen TV, you know, the proverbial flat screen TV." So I said, well, gee, if that's how you feel about it, why did you fund these mortgages to begin with? And I'll never forget, he said, bad regulation. So there you go, right? You know, in January, you know, in January they're in to see me fighting these standards. We're going to construct credit. By October, it was all our fault. But think about the ethics of that for a minute, okay? So I think, and I still see this, I still sense this in the securitization industry that continues to fight reform tooth and nail. One, refusal to accept accountability for their role, you know. I think, and they really believe it. This was all borrowers taking advantage of them, borrowers who weren't willing to pay these toxic mortgages that they were underwriting. Or it was the government failing to come in and step in and put better regulation in. And the thought that they have no responsibility, I mean, whether it was legal or not, whether there were mortgage lending standards in place or not, where was their ethical leadership in making loans and funding loans that people could actually afford? So as I say, that there is plenty of blame to go around on both sides, and there were plenty of borrowers who took advantage of this situation, plenty of flippers out there. But I think one of the more troubling, again, ethical implications of what happened in the subprime market were the people in the lower income neighborhoods, the ones that once had those safe FHA mortgages that got refinanced into these toxic 228s and 327s. They were among the first to lose their homes. You know, and the ones that were flipping, you know, they might have bought 8 or 9 different properties. They didn't put any money down. They didn't document income. They didn't do anything. They just walked away. They could have cared less. But the people who actually were in their homes and lived in those homes for a long time and actually had safe mortgages at one point, they were really the ones that bore the brunt of this. I remember going to a home ownership preservation workshop that Governor Schwarzenegger actually, I know you all have some familiarity with muscular governors, but anyway, Governor Schwarzenegger was actually very good in home preservation. We called him the modifier instead of the Terminator. We called him the modifier because he actually was quite on top of this. And so he hosted this, he was doing these, he would strong arm all the servicers to come out and set up stands to get these loans restructured, and he asked me to come out and speak to one, and I did, and it was quite a moving experience. And you know, there I tell you folks, there were no flippers there. There were people, working class people, in their uniforms, in their you know, with their kids, with their elderly parents, just scared to death, had mortgages they didn't understand, just scared to death about losing their houses. And by this time, this was actually in early 2008, I believe, when we had finally got Hank Paulson, to his credit, then Secretary of the Treasury, to launch a national program to try to get these more servicers to restructure these loans. And the agreement was that they would take these resets and extend the starter rate for 5 years. So you at least give some breathing room on the resetting mortgages, the higher payments, extend them the starter rate for 5 years, and that was the agreement that everybody had, again, publicly signed off on. All these agreements, unfortunately, are voluntary. And I kind of sneak in to listen, overhear what's going on at one of the servicer booths, and there was a woman there, a nurse, who was there with her elderly father. She had a 228. She had never been late on her mortgage. She is exactly the kind of person we wanted to help. She could not afford the reset. She could not refinance. Her home value had gone down. And the guy gave her a 2-year extension. Oh my gosh, after all that, they wouldn't even give her a 5-year extension. I went back to the office and I called the servicer and raised heck with him, and he insisted the investors didn't want to give up the higher interest rate, and that was the best we could do. But, it was just, it was heartbreaking because a lot of those, again, plenty of flippers out there, plenty of borrowers who abused the process, but a lot of innocent families who were victimized in this. And their homes are gone, 7 million of them, their homes are gone. So as the housing market recovers, that doesn't help them. A lot of them have lost their jobs. So the first wave of these subprime loans were the ones that started becoming delinquent and defaulting. Later, as we got into the recession, it was people who had buying mortgages, but they had lost jobs, and they were the true victims. And I don't think that we give them, we understand enough at the Main Street level, the damage that was created by this crisis. And again, I think still a very troubling reluctance by many in the securitization industry to take responsibility for it. So, but bad lending wasn't the only problem, and in packaging these loans into securitizations, it was too much leverage too. There was too much borrowing. Borrowers borrowed too much. Borrowers absolutely borrowed too much. But you know what? Financial institutions borrowed too much too. And then, the ethical ramifications of borrowing. I mean, this is biblical, right? So the debate about whether it's a good thing to borrow or lend money goes back to the dawn of humanity. And certainly there's nothing wrong with borrowing if you need to borrow, it's something you really need. It makes sense. You can afford the loan. We are a society that borrows a lot. I think my personal view is too much, and I actually have written a children's book about the dangers of the virtues of saving over borrowing. But there was far too much leverage. And why did this? So there were moral implications of borrowing more than you can afford. For the borrower on the borrower's side, borrowers have ethical obligations to lenders to take out loans they can afford and repay those loans. But these very large financial institutions had an obligation to us, generally members of the public and taxpayers, not to borrow so heavily that when the inevitable downturn came and they started having losses, they couldn't absorb those losses. So, and that's exactly what happened, and that is why we had the crisis and the recession that we had, because very large financial institutions had too much leverage. Some of them, the investment banks, Lehman Brothers, Merrill Lynch, Bear Stearns, they were funding, there's a lot of business people out here, they were funding with probably at most 2 or 3% of their funding base was equity. The rest was debt. I've seen studies suggesting that Lehman Brothers actually at one point had $60 of debt for every dollar of common equity. Just mind-boggling levels of leverage. You can't really entertain any losses of any magnitude at all without the market running from you and creditors no longer willing to extend credit to you. And of course, in addition to borrowing too much, they were borrowing very short term. So when the markets froze up on them, they couldn't access them. If you're having to go to the market day in, day out to borrow, you've got a problem. And this was a key reason why we had a huge credit contraction and a key reason why we ended up doing all the bailouts that we did, because of excessive leverage and not only borrowing too much, but borrowing on a short-term basis. But it hurt the economy, even though people like to brag, oh, well, the bailouts made money. But I got to tell you, I just hate that. Yes, they made money on a cash flow basis, but the damage caused to the economy, to families, to small businesses, those that were not bailed out, to the taxpayer base, the unemployment situation still very significant. How could you ever possibly rationalize what happened by saying, oh, well, no big deal, the bailouts made money? But again, there were moral ramifications to taking on this excess leverage, because when they did that with their size and complexity and interconnectedness, when they got into trouble, it was inevitable that they were going to have to go turn to the rest of us to bail them out. And so they were not, there again, no accountability for their decision-making, their risk-taking. And though a few went into either our process at the FDIC, which is very harsh, and smaller banks which failed, it is a bankruptcy process, and Walmart and some of the larger ones did as well, and Lehman, of course, went to bankruptcy. Most of them were bailed out, which was wrong, which leads me to too big to fail, because too big to fail is inherently have profound, I think, ethical ramifications, because it's bad economics as well as bad ethics. Because if you're a manager and you know that you've got to put on the government, so you're using a lot of leverage, you want to generate really, really big profits, because you know you can take a lot of risks to have those profits, because if you have losses, you're going to put it on Uncle Sam. What are you going to do? You're going to go out there and you're going to take a lot of risk, and that is inherently destabilizing. But it's also fundamentally wrong from the perspective of how others are treated. It's fundamentally unfair from the perspective of people who lost their homes, small businesses who went bankrupt, smaller banks that failed. This is not, when you have a system where the big guys can make mistakes and they get saved and everybody else has to go into liquidation or restructuring, you again have a system that fosters bigness, it fosters concentration, and it creates incentives for these very large institutions to take risks. And I think Dodd-Frank does have some important limitations on too big to fail now, which I welcome because, again, the inherent unfairness still haunts me. I tell a story in my book about the FDIC, if we have a statutory requirement to impose losses on uninsured depositors if necessary to maximize our recoveries, to limit our losses. And so I remember IndyMac, a policewoman who had just sold her house, had $250,000 or so on deposit at IndyMac. The deposit limit, the insured limit at that time was $100,000. She took losses, a policewoman. I think, she probably took $50,000, $60,000 in loss. There was the mother of an Afghan soldier who had passed away, and she had deposited the life insurance premiums, the life insurance proceeds at the bank. She was uninsured. It was why do we have a system that imposed losses on people like that, but we're bailing out bondholders, we're bailing out foreign banks, right? Derivatives counterparties, paying them 100 cents on the dollar. I don't get that. And I wish that we'd had more discussions about that as we were dealing with the financial crisis. And I think one of my big regrets about the bailouts is that they were far too generous. They were far too uneven. We did not impose enough pain or accountability. And by the way, we kept doing it into 2009. And again, it creates all the wrong incentives. It creates an incentive for banks to take risk. And it creates cynicism, a lot of cynicism among everybody else about the game being rigged, Washington being rigged, regulators being captive. And I hope desperately that we never go down that road again. But that will mean that regulators have to use the tools that Dodd-Frank gave them. And bailouts are quite explicitly banned under Dodd-Frank. But, the regulators have to use the tools and not try to find a way around them, and Congress has to hold firm and not pass another TARP-type bill. And I think the tools are in place now to resolve one of these entities, if these large financial institutions, if they do get into trouble. It'll be messy. There are a lot of things that we should be doing now. We should be making them simpler. We should make their legal structures simpler. We should make them silo their commercial banking and their securities activities and their derivatives and their insurance, their different business lines, so that they can be easily hived off and sent into a bankruptcy type process if one of them fails. And that kind of work is going on now. But it's going to take a lot of guts for regulators to use those authorities. But I think they can and will. And for those who are investing in banks, either buying their shares or buying their debt, I think they need to understand that their money is now at risk for loss. I do not think bailouts will occur again. And it frustrates me that so many rating agencies still give these very large financial institutions a bump up in the credit rating based on this idea that there is still implied government support. I think that's a disservice to investors, because my guess is if one of them gets into trouble, there will not be a bailout. Bondholders will be taking losses, and that should be priced into the decision-making of whether they're going to invest in these banks now. But again, and too big to fail is the type of thing that we don't get rid of until the market and investors and rating agencies believe that it's over. And there again, I think regulators have a lot more work to do before the public is convinced that both the tools are there and that the tools will be used. Another product that really troubled me during the crisis that I think has significant ethical ramifications is this product called the credit default swap. I'm sure a number of you are familiar with it. Credit default swaps are a type of derivative that you buy to protect yourself against credit loss, whether it's a bond or a mortgage-backed security. And it is, in my view, a kind of insurance. So with traditional insurance, right, if you go and buy fire insurance on your house, the first thing your insurance company is probably going to ask you is, do you own the house? And they want to make sure you own the house, because if you're buying fire insurance on your neighbor's house, it will give you an incentive to burn your neighbor's house down, and that would be a bad, clearly unethical result. But with CDS, you don't have that. So CDS is used, and the vast majority of the market is speculative. So it's big. A lot of hedge funds use it. They bet on the direction, they bet on whether a company's going to go bad, or whether the housing market. And in terms of what was going on in 2008, there were a whole bunch of private equity and hedge funds that were short these derivatives, meaning that they made money. The more people defaulted on their mortgage, the more money they made. So what kind of economic incentive does that create? I'll never forget again in 2007, we were pushing and pushing and pushing for wide-scale loan restructurings. A couple of these hedge fund managers came out and publicly opposed me. And then it was reported in the Wall Street Journal that they were short something called the ABX index, which is, again, they were going to make money the more people defaulted on their mortgage. So I think this is something that's not gotten fixed, but I think it's a cautionary tale. I would like to just see a ban on speculative use of CDS. I think we should have an insurable interest, just the way we have with traditional insurance products. But that, yet again, is another reform that I don't think we're going to be seeing anytime soon. And again, it creates all the wrong incentives. So I think finally, we need to probably talk about what's been happening since the bailouts, because it's been said that the bailouts saved the system. I got to tell you, I think the bailouts saved the banks, and the bailouts did a good job of saving the banks. And perhaps if we had not, we needed to do something. I've never questioned that we needed to do something. Whether we need to do as much as we did, I think that's a real question. But we didn't really save the economy. And even though I think the Fed has been heroic in what it has tried to accomplish through monetary policy, my view is at this point, we really it is probably creating more problems than it's solving. And what is it? My grandmother used to say, "The road to hell is paved with good intentions." Well, this is somewhat. I fear. I'm glad they're getting out of it now, the quantitative easing, because I do think it's had actually a negative impact on our economic growth. So, for instance, traditional banks that take deposits and make loans, and both, like our sponsor, U.S. Bank, right? You look at these traditional banks that take deposits and make loans, they didn't have any problems during the crisis. They managed quite well. They remained profitable. They helped us in terms of resolving some of the smaller institutions that were failing. And they lend. That's what we want banks to do. They lend. That's how they make money. They don't do the derivatives. They don't do the trading operations. Their bread and butter is lending, and those banks, the regional banks and others that follow that model, did pretty well. But what do you do when in this super low interest rate? It is hard. Your margins between what you have to pay on your deposits and what you're getting on a loan is difficult. And so I think it's and plus if you're a big investment bank or universal bank with big trading operations, a lot of corporations have been reissuing new debt. You can get big underwriting fees from that. And then you can invest in government securities and GSE securities and others. And as interest rates have stayed low and the Fed has increased demand for those types of securities, those if you've got those big trading books, those have appreciated in value. But if you're a lender, this interest rate environment is not so great, and it's not in credit to banks like U.S. Bancorp. They've stayed in the game and have been supporting their communities. But it's not. It is counterintuitive, but I don't think it's conducive to good lending. Plus, it's made. Let's face it. It's made the rich a lot richer. The financial asset inflation that we've seen. Stock market is up like gangbusters. Bond market is up. That is all driven by quantitative easing. These huge interventions that the Fed has made into our markets. And so you look at what's going on with wages, you look at what's going on with unemployment, not so much improvement. Wages have stagnated. We saw a little bit of a bump up in real wages in February, but they fell back down in March. And I do think, at some point we need to find out how good this economy is on its own without these extraordinary measures that the Fed is taking. And my personal view, as one who's on a board and advisor to several companies, my sense is the uncertainty of not knowing exactly where we are, because we have all this money going into the system from the Fed, is making people cautious. Are we going to have another crisis again? When they pull out, are we going to have do we have bubbles that are going to pop the way we did with the housing bubble in 2006? So I think getting out would be very, very helpful, and I think would give us a stronger, more real economic recovery, real economic growth, give corporate leadership more confidence or at least knowledge about whether to invest or not. Because now they're looking at their share valuations. They're saying, well, how much of that is me and how much of that is the Fed? And so I do believe that Janet Yellen is doing a great job. I was a big supporter of hers getting out, and she doesn't agree with me on monetary policy, but she's got a lot of common sense, and she is leading us out of this now. They need to do it very slowly, very gradually, because there will be some corrections, I'm sure, along the way. But it's time for us to find out just how healthy we are without these interventions. And frankly, it's time for Congress to step up, too. Let's have some leadership from our politically elected leaders, not put it all on the Fed. Fundamental tax reform, infrastructure spending. I think there are things that we can do to get the real economy going that have not been happening because the whole debate has been centered around monetary policy. So, I think what will be the new paradigm, the new ethical paradigm in financial services? I think one thing that strikes me is that bad ethics are almost always bad economics and bad business management as well. I mean, you look at the housing bubble, making all these unaffordable loans, not documenting income. Obviously, once you detach the decision, the availability to make a mortgage, give people credit to buy a house, if you disassociate that from the income they have to pay for that mortgage and use a lot of leverage, no down payment, you're going to get a bubble. When you tie mortgages, you tie lending to the actual ability to pay with real income, the home prices are going to stay at some correlation to real wage growth. But once you disassociate the two, you get a bubble. And that was broadly damaging, not just to individual families, but to the economy as a whole. And the bailouts, what are the ethical ramifications of that? Have we created incentives to do it again? I hope and pray that Dodd-Frank sends all the right messages and is very vigorously implemented by the regulators to make it clear that it's not going to happen again. No more bailouts. You will take your losses. If the managers of these big institutions, if you get us in trouble again. But again, probably somebody says we need a failure, like a medium-sized failure to actually prove it'll work. But actually, Dodd-Frank is quite tough. Not only does it put them into a bankruptcy-type process, but pretty much the boards of managers have to be fired of these large institutions. There's a 3-year clawback of all the compensation they've received for the past 3 years. So it is quite harsh. And I hope, again, it needs to be implemented, but I hope that will create not only the right legal mandates, but the right ethical mandates. And also, finally, getting back to a real economic growth where we're not relying on asset inflation, whether it's housing or the stock market or bonds, but, real economic growth. Companies like Land O'Lakes producing products that people want to buy and then have value and feel good about. It's a win-win situation. And I would like to see more of that kind of sense in the financial sector. Again, I think you do see it in the more traditional banks, but in the Wall Street banks, some of the trading culture is not so much one of customer service and providing things of value. So everybody feels good about the transaction. It's kind of they're Muppets, right? So are they marks? Are they targets? Or are they people, are your customers people who you want to provide value added so they feel good about what they're paying you and you're actually helping them. The nice thing about a prudently made loan is it is win-win. A bank, U.S. Bank or whoever makes a loan to a small business to start or grow. It's a loan they can afford, presumably. It grows their business. U.S. Bank makes some money off of the interest. That's a win-win situation. Trading operations are not that. I mean, I think that's why I would like to see some form of Glass-Steagall reinstated. I think it can be done through the regulatory process. Because trading is, if I sell you a stock, if that stock goes up, I lost, you win. If the stock goes down, I won, you lost. But somebody's got to win and somebody's got to lose. And so that kind of activity is needed, and it has a legitimate economic function, but is it the kind of thing that we want in the traditional safety net banking system? I don't think it is. I think we want credit intermediation. We want things that clearly provide support to the real economy. We don't want a lot of just trading for the sake of trading, and that's what the Volcker Rule has been designed to impose on institutions that are part of the safety net. But how effective that'll be in practice, it's a very complicated rule, is yet to be seen. So I think there's a Robert Frost quote that I like to quote from his poem, The Black Cottage, where he said, everything, all the truths we think we see in life are really, all the change we think we see in life is really truths coming in and out of favor. And there's an old Broadway tune that probably says it more succinctly, which is everything old is new again. So, you know, the ethics of speculation, leverage, short-sightedness, greed, these are not new. These are ethical debates that we've had for a long time, and yet we keep repeating them. You know, pretty much any financial crisis you can find throughout history have been driven by those elements. So I hope that after this last debacle that we can get into a financial system that is more long-term thinking, shareholders too in financial institutions willing to give up those short-term, you know, highly leveraged profits in return for sustainable long-term growth, sustainable steady dividends, as opposed to you know, trying to make a fast buck through a lot of leverage. And I hope bank customers will heavily scrutinize their relationship, and this, especially with the corporate customers. Are they being treated well? And go someplace else if you're not. If you're being treated like a muppet, don't go there. Go someplace that's going to appreciate your business. I think voters, too, have a role in this in terms of, you know, there's tremendous pressure on the regulators now to stop reform. Amazingly, after this terrible crisis, there is still a lot of political pressure not to move forward on many of these rules. The regulators, to their credit, are approving today a measure that will dramatically, significantly increase capital requirements for the largest financial institutions. I strongly support it, but it's been a long time getting this done. Could be stronger as far as I'm concerned, but they had a tremendous amount of pressure to not do it. They are moving forward. But if voters don't notice what's going on in Washington and push back when members of Congress try to beat up regulators for trying to put some common sense discipline on the industry, if the voters, if their constituents don't push back, the lobbyists are inevitably going to win. So voters need to be informed, consumers need to be informed. If the ethical paradigm for financial services is to change, we all have a role. And most importantly, the leadership of these firms have a role. You do have many outstanding leaders, especially, again, of the traditional banks. I think we need more of that traditional banking culture, I think, in Wall Street, where you look at consumers and your customers as those to provide something value, to build a relationship, to make it long-term, to make it win-win on both sides, and not just something to be exploited for a quick buck. So thank you very much for letting me share my thoughts with you today, and I'll be happy to take your questions now. Thank you.
I'll invoke the privilege of having held this microphone for a while now to ask the first question. You write at the end of your book about fearing that an amnesia has set in the general public not long after we went through the debacle. And I'm just wondering if you have ideas of how we might get clear, understandable information to the public in terms of if it is financial literacy that is at the core of this problem. How do we get information to folks, and how do you make us really care and make this information feel relevant to our day-to-day lives?
Right. Well, I think that's a really good question, because I do think there's a bit of an effort to obfuscate what the causes of the crisis were, and if you obfuscate what the causes are, you're not quite sure what to fix, and that impedes reform. So I think getting clear, understandable information to the public so they can mobilize and engage on this is essential. We try to do that. We have the Systemic Risk Council is my group. It's part of the Pew Charitable Trust. You can access the website through Pew, or just Google systemicriskcouncil.org, where it's a very distinguished group of people who have been in financial services for a long time, and you can read our comment letters and the kinds of things we're focusing on if that can be helpful. But we need to simplify these rules. Too much leverage is not hard to understand. We have thousands of pages of rules on how banks should view the riskiness of their assets. And at the end of the day, that's a really hard thing to do. What's safe one day is risky tomorrow, and vice versa. Just look at sovereign debt in Europe, once viewed as safe, and banks loaded up on it, and then look at the problems they had. So simplifying rules by just saying you cannot have leverage that exceeds a certain level. We don't care how safe you say your assets are, your leverage cannot exceed a certain level. Those are the kinds of things that are easy to enforce and easy for the public to understand, and we need more of that.
You have written, however, that the way the public interpreted many of these problems is in the way that you described in the anecdote with the people on Wall Street. They blamed the government,
everybody
basically.
but themselves.
So where is the message going awry in terms of making ordinary Main Street people get clearer information?
Right. Well, again, I think they need to engage. There are groups like mine who try to provide that information. I think, too, you should be bottom line oriented, too. You know, if there's another LIBOR scandal or London Whale or whatever, you should be raising heck with your congressman. You just want to see it anymore, right? We have deposit insurance, we have central bank lending, we have all these supports for the banking system to make it stable. And you don't want to, this kind of conduct is just not something you want to see. And ultimately make them accountable. I think that's a simple soundbite, to complain about it and to raise heck about it. And what are you doing about it? I think those are the kinds of questions you can ask, and don't take for an answer, oh, well, it's complicated, or, don't take that. It's not complicated. Fraud is not complicated. Leverage is not complicated. So customer abuse is not complicated. So be results-oriented, raise a ruckus when these scandals occur and problems occur, and let your congressman or woman know that you want them fixed. You don't want them putting pressure on regulators to not do anything. You want them to putting pressure on regulators to do something, to get it fixed.
Just a quick follow-up on that. What do you think of the role of the media in conveying clear information? How would you grade them?
Problem. Yeah, I think it's frustrating to me. Because whether it's regulated, the problem is it's what I call cognitive capture, and you find it with regulators and you find it with media too. When day in, day out, you're dealing with the same financial institutions, their managers, their lobbyists, that's who you're talking to on a day in, day out basis. If you're a media person, they're your source. You start seeing the world through their eyes. You just do, and you need to make a conscious effort to talk to a broader range of people. I just sent a very strongly worded email to the Wall Street Journal this morning because I read an article about this leverage ratio that's being approved today that I was speaking of that had nothing but industry quotes bashing it as constraining credit. Oh my gosh, as a regulator, everything I've ever tried to do as a regulator would either constrain credit, right, make credit more expensive for you, or hurt our international competitive position. Those are the two standard talking points, and they usually don't have much behind them. So I sent him an email and complained about it. I said, there's lots, why didn't you talk to people on the other side? And he apologized, and hopefully we'll get a better balanced story tomorrow. But you have to stay on them, and again, that's one of the reasons why I formed this group, is because we have a lot of influential people on our council. We have credibility, and we push back on the other side. But I think reporters have to be very, very aware of this. They are subject to cognitive capture as much as regulators.
Is the 5% reserve being voted on today by the FDIC and Fed adequate to prevent systemic failure?
Right. So it's a 6% capital requirement for insured banks, and then 5% for the banking organizations. So understand these very large financial organizations, these universal institutions, have activities inside their bank, and then they have a lot of activities outside their bank. And so for inside the bank, it's 6%. It's 5% for the total organization. Now, I'd like to see it 8%. I would. Those numbers, though, are a little stronger than they sound because they include a lot of what we call off-balance sheet risk. So under U.S. accounting rules, there are a lot of risks like derivatives that are not necessarily kept on the books. And so this rule captures some of those off-balance sheet risks as well. But I'd like to see 8%. If you look at like U.S. Bancorp and others that managed well during the crisis, they were above that level, and I think 8% is a good benchmark. But 5 and 6, that'll be about another $100 billion of capital into the system, which is helpful. It is helpful.
Mm-hmm. Question that seems related to it: if the Fed Reserve would charge banks for holding their reserves, would banks start to lend more?
Yeah. So let me just clarify that there's a difference between reserves and capital, I think. So capital, and this is important to understand because some of the industry people in Wall Street who have opposed tougher capital requirements portray capital as something that you sit on and hold and don't lend. And capital is just a reflection of how much you fund with equity versus debt. So if you go out and raise money in a common stock issuance, you can certainly take that money and go lend with it, right? It's just that if you have losses on those loans or whatever you're doing with it, it's loss absorbing because you don't have an obligation to pay shareholders back. You have an obligation to pay debt holders back. You don't have an obligation to pay shareholders back. So I think that's first. Capital is different from reserves. Reserves, and there are a couple different kinds of reserves. One is what's called loan loss reserves, which are held on a bank's books, and those are they're accumulated to cover expected losses. So if I have a portfolio of loans and under these market conditions I think my losses are going to be X, so the bank will hold reserves. And then there are what they call reserves and excess reserves held at the Fed, and I think maybe that is the question what your questioner is getting to. And that's been quite controversial because there are massive reserves. I think about $2.5 trillion of excess reserves currently at the Fed. And the Fed is actually paying the banks 25 basis points to keep those reserves there so that the Fed has a way to fund their balance sheet because they've been going out buying all these mortgage-backed securities and government debt. As I said, they're tapering. So there are a lot of economists, John Taylor at Stanford one, who say that you should stop paying that 25 basis points or even assess a negative so that they will release some of those reserves and lend more. I think that's probably not going to happen because I think the Fed likes it the way it is. But there is a massive amount of money just sitting at the central bank right now that's right. It's not being lent out and perhaps could be helpful in the economy.
The questioner asks, why Dodd-Frank? Why not a return to Glass-Steagall?
Yeah. Well, I just don't think there's political support for it. It really got no traction during the Dodd-Frank debate. Elizabeth Warren and John McCain have co-sponsored a modern-day version of Glass-Steagall. I think it will get traction if there's another London whale problem or scandal of that nature. I have argued in my book that regulators, I think, actually have a lot of authorities from the standpoint of safety and soundness, as well as their mandate to make sure these banks can fail in an orderly way if they get into trouble, to require them to simplify and restructure along business lines. I think people talk about size, but it's really more complexity. So if you're trying to run a commercial banking operation and a traditional investment banking operation, if you're running a big derivatives dealer and a commodities dealer and an insurance company or what have you, those are definitely different skill sets that if you're trying to manage them from the top is extremely difficult. So I would like to see structures where those activities are siloed with their own individual boards and managers that have expertise in those areas and also are easier to sever off. They have their own capital and liquidity, so if one of them gets into trouble, if your investment bank gets into trouble, you can hive it off, send it into bankruptcy. Your commercial banking operation is still over here functioning. And I think they're moving that direction. How far they will go, I'm not sure, but I do know that these banks are being forced to simplify their structures and better align their legal structures with their business lines, and that is consistent with a trend towards a Glass-Steagall approach.
Let me follow up on that. You mentioned on several occasions U.S. Bancorp as being one of these companies that stayed relatively circumspect
right.
despite the elimination of Glass-Steagall. Was there an incentive system beyond, was it more than ethical leadership that might have accounted for that?
Well, that's true. A lot of, actually there are very few banks that have tried to, I think, commercial banking is if done right, can be a very profitable win-win for shareholders, borrowers, managers. And so I think well-managed banks recognize that and don't foray into these other areas unless, there is some value added to the franchise. And my fear is with a lot of these mega banks, they were kind of acquisitions for the sake of making acquisitions. So every time you buy something, you get a whole round of bonuses and everybody pays themselves nicely. Oh, we got a do deal. And I think this is one of the problems you see with Citigroup, though I think the managers there are trying very hard and they've got talented people in leadership roles. It's just, it's not always clear that there are good economic synergies with having, combining these different different types of businesses. And they say that the diversification helps, but we saw during the crisis when it all goes bad, it all goes bad. And the trading operations were having a lot more trouble because they're mark-to-market, so the losses were a lot more sudden than the traditional lending operations. So it's not clear to me that there are economic efficiencies at all. I think there are economic inefficiencies. There are certainly management inefficiencies. As I said, it's very difficult to manage a complex organization from the top, or have managers that are skilled in all these different business areas. And again, I think, and it's not, I'm picking on U.S. Bank because I know they're a local bank and familiar to you, but if you look at most of the well-managed regional banks, I actually did a Fortune column on this about a year and a half ago, and Mike Mayo, Jim Milstein, a number of bank analysts have looked at this. If you look at the share performance of the regional banks, again, follow the traditional commercial banking model, their returns, their shareholder returns, even in the lead up to the crisis, were beating the mega banks with all their leverage and all their, their so-called sophistication and high-risk activities. That bread and butter banking, if done right, can be very stable, very profitable, and good for the economy. And so I think, don't take my word for it. Look at these analyses, and the returns pre-crisis and through the crisis consistently beat out even J.P. Morgan Chase, which is probably the most profitable of the large institutions.
Mm-hmm. There's a question that sort of continues on the theme of some concern about the banking sector and the big banks. It doesn't seem that much has changed in the banking sector, i.e. too big to fail, since the Great Recession.
Not enough, yeah.
Will it take a complete collapse of the banking system to lead to a meaningful change? And I wonder, in follow-up, whether you would rate the chances of, or the danger of that occurring again.
Yeah, I think things are incrementally better, but not where they should be. As I said, I applaud what the regulators are doing today, but I think those capital levels need to be even higher for the very largest institutions. I think there needs to be more to get them restructured and simplified so that they can fail if they get into trouble, and that will also produce, I think, additional management efficiencies. Short-term borrowing is still a problem. So as I was discussing, banks, financial institutions were not only borrowing too much, they had too much leverage, but they were borrowing on a short-term basis. And again, the big Wall Street banks continue to heavily fund in very short-term lending markets, which again, if there's a shock to the system, their sources of credit, their sources of money to fund their operations can dry up very quickly. I also, as I said, I know they're smarter than I am, and so I'm hoping they'll get out without any kind of market corrections. I do think both financial assets are overvalued. I think there's a chance over time we will see some correction in both the stock and bond market. Hopefully that'll be slow and gradual and somewhat offset by increasing growth in the real economy.
Coming to Washington now, with sequestration marching forward, what do you think some of the near and longer term effects will be?
Well, look, I'm all for fiscal responsibility and dealing with we are on an unsustainable fiscal track, but sequestration is really a dumb way to do it. When sequestration was originally supposed to be so harsh that Congress would get its act together to come up with an alternative, because sequestration would have such bad consequences. And so we did get a budget of sorts, so they could keep chipping away at the budget agreement that was made. And my guess is sequestration will continue to erode over time, but if it's not replaced, we do need a plan. I'm not one of these people that says, oh, well, we don't need to worry about Social Security or Medicare now. Wait until they're actually out of money or short of money, and then we'll deal with it. That's just nuts. The longer time you have, you can deal with it incrementally and accumulate, through the power of compounding, you can accumulate the savings over a period of time. You wait until the trust funds are falling short. You're going to have to whack benefits a lot more or raise taxes a lot more to fix it. So I don't get that. I think we should be dealing with those problems now. I think fundamental tax code reform, you could improve the economy and still pick up revenues. Our tax code is an embarrassment, both personal and corporate. Nobody pays the top rate except for dummies like me and probably a lot of people in this room. We're paying, but what are our tax rates? And the private equity guys are paying 15-20% rates there, go figure. But the corporations, it's the same thing. Nobody pays the top rate. The top rate's too high. It's uncompetitive, but nobody pays it because there's so many loopholes. So getting the top rates down but broadening the base, you can actually make sure everybody's paying some fair share and get these distortions out of the economy where people, investments chasing the tax breaks, not necessarily where it economically makes sense to put the investment dollars. It's where the tax breaks are. So I think that would be huge. I think you can do infrastructure spending as well in a fiscally responsible way. You could do it on a pay-as-you-go process, but providing some government support, I think, for infrastructure financing would put people back to work, and we need it. Whether it provides stimulus, but we need it regardless of whether the stimulus is there or not. So there are things, sensible things that we could do, not sequestration, but whether Washington will actually get its act together and do that is anybody's guess, is as good as mine.
On this theme of crookedness and fraud, the questioner asks, why has no one gone to jail?
Yeah.
How well are the rules and regulations written, and do they have teeth?
Yeah. You know, it is amazing that, especially if you look with these mortgages, I mean, there have been, at the origination level, there have been some mortgage brokers who have gone to jail, but certainly the higher levels of management. And one thing, so it was so blatant and obvious that somebody knew what was going on, but we just haven't seen that. And then we have, when we have civil cases, and sometimes a civil case more be appropriate than a criminal case, but then the corporation is paying, right? The bank, the shareholders are paying. It's not people paying out of their personal pocket. So I don't know. That's somewhat of a mystery to me, that we have not had more vigorous enforcement actions, and again, more personal accountability for not putting on the shareholders, but on the individuals themselves who made these mistakes. We haven't had it, and again, if we're going to create a culture that reinforces ethical behavior and discourages or penalizes unethical behavior, we need a more robust enforcement presence. We just don't seem to be getting it.
Sheila Bair, thank you very
Sure,
much
thank
for
you.
a very engaging presentation. Thank you.
Understanding the New Financial Paradigm with Sheila Bair is a Minnesota Partnership co-production of the Hendrickson Institute for Ethical Leadership and the Undertold Stories Project of St. Mary's University of Minnesota, and Twin Cities Public Television, with support from Land O'Lakes and U.S. Bank.